We're covering planning and paying for large expenses in retirement. This is an issue because we've noticed opportunities with clients that we're working with on using some different strategies for handling large, one-time or periodic expenses. And so we wanted to outline how to plan for some of these expenses and then also show you some of the potential benefits that just a little bit of planning can have. Feel free during the webinar to type any questions into the chat box if you have any. I'll try to keep an eye on that as I go. You can send questions to everyone, the group as a whole, or just me if you want. I'll try to watch the chat as I go through, but if I miss something, I'll certainly come back and answer any questions at the end. And Quinn's normally my audio check and visual check here, so if any slides aren't showing up for you or the audio sounds bad, just holler, let me know, and we'll try to fix it. And with that, we'll get started. Thanks again. I thought maybe the best place to get started would be a relatively straightforward example. For example, we're looking at a recently retired couple in Iowa with a decent Social Security income and living expenses of about $80,000 a year. And on top of those normal living expenses, this year they want to purchase a car, which will be an increase of $35,000 in expenses for them. And this couple's largest form of savings is their traditional IRA. And because it's this couple's largest account, they use the IRA to fund all their spending needs that are in excess of the income they receive from Social Security. And so for this example couple, what happens? Well, they're going to have to withdraw an extra $35,000 out of their IRA to pay for the car. And as you might imagine, that causes a little bit higher of a tax bill for this year than what they're used to. You can see here what the assumptions of their 2020 tax bill would be in this scenario. And in total, because these IRA withdrawals are taxed like normal income, they would pay just over $15,000 in total taxes in federal and state, based on the assumptions above. And then after 2020, when they don't have this extra expense from the added car purchase, their tax bill would go back down to a more normal level. But they definitely had this 1 year spike in taxes from this extra large withdrawal from the car. And in total, over this 2 year period, it's about $18,700 in taxes for them. And now we're going to get into a little bit more details on how I calculated these numbers later and why that $35,000 purchase can have such a large increase in that tax bill for 1 year. But for now, just keep this $18,700 number in your mind. And let's look at what would happen if this couple did just a little bit differently. Instead of pulling out all $35,000 1 year, this couple now pulls out half of the $35,000 in 2020 and the remaining half in 2021, or the next tax year. All that matters here is that the tax year that the withdrawal takes place is different. So this can be $17,500 withdrawal on December 31st, 2020, and the remaining on January 1st, 2021. What matters is that $35,000 is just getting spread out over 2 years. And just this one move, relatively simple, ends up lowering their 2020 tax bill pretty substantially. And of course, they have this slightly elevated tax bill still, also in 2021. So they would have 2 years of, about this $8,000 tax bill. But in total, just with spreading out this withdrawal over 2 years, they've reduced their total taxes due over this 2 year period by a little bit more than $2,500. And not a bad return from just a little bit of planning. And so I wanted to start with this example just to give you an idea on why planning around some big expenses like a car, just for example, can be beneficial. And now $35,000 cars might not be your thing, but I don't think it's unusual for a newly retired couple to have some periodic jumps in their spending, somewhere, especially early on in retirement. It might be a home renovation. It might be a year with lots of travel, which we'll all be due for after, the coronavirus passes here. It might be medical costs. It might be the purchase of a new home or a second home, which, as you can imagine, after seeing the numbers just from a car purchase, a home purchase, or something much larger can have an even bigger impact on the tax bills. And so we have an example later that looks into this type of a scenario with purchasing a second home as well. And so this was an example I was hoping would catch your attention, just to show how these one-time expenses, even somewhat moderate expenses, can really impact you. And so why do these big one-time expenses cause such a big impact in your taxes? Well, it's because the tax law, the tax code, has several cliffs, what we like to call them, or areas where if you hit certain levels of income, your tax rate can really increase rapidly. And in the first example, a big reason why this example's household tax bill went up quick is because of how our tax brackets operate. A lot of times people describe the way our income tax brackets work is by thinking of each bracket as a bucket that fills up. And as you earn more income throughout the year, whether you're earning salary at a job or just withdrawing from your IRA, these buckets begin to fill up. And for 2020, the first $19,750 is taxed at 10%. This is the same whether you're Warren Buffett or an 18-year-old, flipping burgers. That first 19,000 you make is taxed at just 10%. And as you earn more, that 10% bucket fills up. And once you fill it up, the next bucket begins to fill. And right now, with the tax law, that next bucket is the 12% bracket. And in this bracket, you can earn an additional $60,500 and have it be taxed at just 12%. And this goes on. The tax rates increase as your income increases. And as you earn more, that additional income will be subject to a higher tax rate, a 22% or a 24%, and so on. There are a few more brackets than what I'm showing here, but just to keep it simple, I've stopped at that 32% bracket. And now one thing to notice is that some of these tax buckets have tax rates that are very close. Moving from the 10% bucket to the 12% bucket is, just an increase of 2% in your tax rate. It's an increase, but it's not that bad. But there are certain tax brackets that have these relatively steep jumps. And this is just one of the cliffs that I kind of referenced about earlier. And that's after the 12% bucket, the next step up is the 22% bucket. This is 10% higher, than the previous bucket, and almost doubles your tax rate on any additional income. And what was happening with our example client that we looked at on the previous slide was that their normal expenses and Social Security income led them to just about entirely fill up that 10 and 12% bucket. But when they took out that $35,000 for the car, that $35,000 was almost entirely in the 22% bucket. And so that $35,000 got taxed at 22%, and just the taxes on that $35,000 withdrawal was almost equal to the taxes on their full $80,000 in income from normal living expenses and Social Security. We then showed that spreading that couple's car expense over 2 years dramatically reduced that tax bill. And that's because what was happening was a lot less was spilling into that 22% bracket for most of that withdrawal. And so the tax brackets are a big source of increase in taxes for this example household. There's one other thing to explain that really sharp rise that this example couple experienced. And that other is because of how Social Security is taxed. Social Security has its own cliffs or levels of income that can cause, these sudden increase in taxes just from relatively smaller withdrawals. And so at lower levels of income, Social Security is not taxed at all. And as you earn more income from other sources, usually IRA withdrawals are the big sources of income for retirees. More and more of your Social Security gets taxed. And to avoid getting into too much detail, I'll just say, at a maximum, 85% of your Social Security benefit becomes taxable. And these levels change every year based on inflation, but the numbers here you're looking at are for 2020. And if you have combined income of over 44,000, you kind of trigger that 85% threshold. And so in years of low income, the percent of your Social Security that's taxed will probably be very low. For that example client we looked at, if all they did was collect their $2,400 a month in Social Security, they would have no taxes due at all. But the IRA withdrawals bump them over these cliffs. And after the living expenses and the car withdrawal, all of a sudden, they not only paid taxes on that $35,000 withdrawal to pay for the car, but that income also caused a portion of their Social Security to now be taxed as well. And this caused a bit of a feedback loop for our example household. Since more of their Social Security was taxed, it fed more money into those buckets that we looked at earlier, which filled up those lower buckets faster and led to a lot more money being taxed at 22%. Rather than the lower 10 and 12%. And if you've sat through any of our webinars before, there's a lot of complexity when it comes to the tax code. There's a lot more of these cliffs that retirees who have large one-time expenses end up encountering. And we're not going to go through all these in detail. We've gone through a couple of these in previous webinars, but just to give you an idea on other items that trip up retirees with large one-time expenses, IRMA or the Medicare surcharge. This is if you're over the age 65. One-time increases in income can raise your Medicare costs, and this is a very sharp break point where even $1 difference in income can cause you to pay tens or hundreds of dollars more per month for your Medicare Part B. And if you're married, this kind of counts double against you because both spouses are going to get that surcharge or that increase in your costs. And we were looking at federal tax brackets earlier, but state tax brackets also operate in a similar fashion. And for those in states that have high income tax, like Iowa, these buckets kind of have the same effect. For Iowa, for example, that top tax bracket is about 8.5%. And so it doesn't do as much damage as the federal tax rate, but it certainly adds to your tax bill. Oops. And then long-term capital gains are another one. These are taxes from your investments outside of your IRA and a taxable brokerage account. Under a certain amount of income, these are subject to actually a 0% tax rate. But once you get over a certain level in taxable income, they become taxed at 15%, and then there's a higher 22% tax rate as well. And so again, a big jump that once you cross over certain levels of income, your tax liability kind of compounds very quickly. And there's a lot of other smaller different tax credits and deductions that you can qualify for based on your income. Just one example, in a previous webinar, we talked about the CARES Act and the stimulus checks that were going out, which were tax credits that were based on your income. And so if you had a very high income from a large IRA withdrawal the prior year, for example, you may have been disqualified from receiving that tax credit. And so all this is a long way just to say that we see tremendous benefits in being able to help you plan around these big one-time periodic expenses. Maybe you've seen in our plan with you that we're accounting for car replacements periodically every 5 or 7 years in your plan. And having that on the radar helps us identify some high and low tax years and find some of these opportunities for you. Technology's made this a lot easier for us to do. So just from technology released, I mean, really over the last couple of years, we're able to do much better planning around this. If we've talked to you about Roth conversions, for example, some of these images might be familiar to you. And we also are able to analyze tax returns much better. Some of these other images here show some reports that we can print to very quickly identify where you land in some of these different tax brackets and buckets that exist, and how close you are to maybe one of those cliffs that we just talked about earlier. And so for clients, we like to do this heavy lifting for you, of course, but we like you to know, some of the whys behind some of our questions that we might ask you in planning, and some of the planning that goes on behind the scenes, and maybe what's important for you to include, when to include us into your planning too. If you are planning for a larger expense, this can be why it's important for us to, maybe know about it. And it's a little bit of work, but there can be really good reasons to do this plan, and it can be very beneficial. And as another example, and just switching gears a little bit, but building on that same information we covered on how the tax brackets work, another really valuable analysis we found that helps clients out recently is the potentially positive impacts that loans can have on your financial plan. And I know this might sound a little bit crazy. You've saved your whole life with the idea that you would eventually save enough to not need loans in the future, and certainly not in retirement. And that's very understandable. But as you've probably seen from yields on your bank savings accounts or yields on your bond funds at Schwab, interest rates have really come down dramatically. And while it's not fun to see those lower interest rates on your savings, it also means that rates have come down dramatically for loans that typical retirees can take and very easily qualify for these large one-time expenses in retirement. I'm thinking specifically car loans and mortgages. A lot of new cars can be financed at 0, 1, or 2% today, and 30-year mortgages are getting close to, believe it or not, 2.5%. 15-year mortgages are getting closer to 2%. If you haven't looked at rates lately, I know you probably don't believe me, so I grabbed this screenshot from Green State Credit Union just this morning. And if you're thinking about our previous example and those tax cliffs that triggered these much higher tax rates, you might see where we're going with this, because if you can borrow at 2.5% to avoid 10 or 20% increase in taxes, there's a nice opportunity there for you to take advantage of the difference and save a little bit of money. And so let's look at a quick example. We're using the same example household that we looked at before, but now they're looking to buy a $175,000 condo for a second home somewhere. And again, they, like many retirees we see, have a lot of their money saved in IRAs. So they don't initially think about taking a loan because, why would they if they have enough money in an IRA saved up to fund this purchase and still meet their other retirement goals? And so they want to use that IRA savings to pay for a house. And this means a big withdrawal from their IRA this year. If this couple uses their IRA to fully fund the purchase of this home, they're looking at about a $70,000 tax bill for the year. It's a really high jump. And as you might expect by taking this, big one-time withdrawal. And then over the next few years, their taxes drop back to a more normal level. But because, they had this big tax bill early on, their tax over this 5-year period that we're going to use is just over $91,000. So keep that number in your mind. And now we'll look at what happens if this exact same couple decides instead to take out a mortgage, a 15 or 30-year mortgage, just to help spread out some of those expenses. But here we're going to assume that they don't take all 15 or 30 years to pay off the mortgage. They're just going to do it in a 5-year period. And so they have a much lower tax bill than that $70,000 one that we saw before, but they do have a little bit elevated taxes for years 2 through 5. And in total, their annual tax bill is going to be about $14,400 for, the added withdrawals they're going to have to take to pay off this mortgage over 5 years. But in total, that's going to result in a tax bill that is much lower than if they had taken out that $175,000 all in one fell swoop. In total, it results in a tax bill of just over $72,000. And right away, you can see a big difference in the total tax bill between these two scenarios. We need to add one more thing to kind of make these scenarios fair, and that's adding the interest that a mortgage would have in this case. I used a little bit higher rates than are available today just to be conservative, and over 5 years of paying back that mortgage, this couple would have about $10,000 in interest on the loan. But still, even when we factor that in, we're close to a $10,000 net benefit for this sample household by taking a loan to buy this house. And so this can be a surprise for many retirees. And again, a very significant potential savings that was a result of just a little bit of planning on the potential benefits of spreading this cost out over a few years and avoiding those really high tax buckets and hitting those certain cliffs we talked about. And when we look at the impact of loans, not only on taxes and the interest that you might pay, but with your financial plan as a whole, there can be some other benefits as well. First of all, by taking out a loan, more money can remain invested. And now, of course, the market can be volatile, so this is no guarantee by any means, but on average, the market has been going up. And even if we apply a relatively conservative annual growth rate over those 5 years, the money that stays invested instead of paying off the house, in one fell swoop, would earn about $17,500 in interest just for this example couple. And so if you consider that $10,000 in tax savings, net of the interest costs, and then now add this $17,000 that their investments would gain, we're getting close to $30,000 difference between these two strategies on paying for a house. And of course, there's no guarantee that this part of the equation works out this way every time. Again, just based on history, the number of 5-year periods that have had significantly low returns is relatively rare. And then perhaps more importantly is that we find a mortgage for a retiree provides a lot of added flexibility in retirement. In our example, we had a household pay back the mortgage very fast, over just a 5-year period, but they would have likely taken out a 15 or a 30-year mortgage, not a 5-year mortgage. And so if they had an emergency expense come up somewhere, or the stock market, really dropped and they wanted to leave money in their accounts for longer to give it a chance to recover, they could reduce their monthly mortgage payment back to the minimum that would be required for that 15 or 30-year mortgage and take reduced withdrawals from their portfolio over that time. And so this is related, but when we look at this through a Monte Carlo simulation, which is where we run a client's portfolio through a randomized set of stock market returns over time, we find that these loans really reduce some of the risks that are associated with sharp declines very early on in retirement. And a retiree is most vulnerable really to big dips in the stock market early on in retirement. But early on in retirement is also when retirees tend to have some of these higher one-time expenses. And so when a new retiree takes a big chunk out of their portfolio really early on in retirement, like to completely pay for a house, it technically creates just a little bit more risk from the stock market drop early on in retirement. A loan, even a shorter term loan, like a 5-year loan in our example, helps reduce that risk because that money, there's less money that needs to come out of the portfolio in periods of potentially really poor returns. It's a small factor, but it certainly is an additional benefit for the flexibility that a loan can provide retirees. And so we're wrapping up now. We blew through a lot of numbers there, but I wanted to show you some real world examples on how these, maybe seemingly small decisions can make $1,000 differences in your finances. And all this really adds up. You'll likely buy, a few cars in retirement and likely have a few other large one-time expenses for home renovations or home purchases. And each one of these is a chance to do some planning and potentially save a little bit of money in taxes on each step of the way. In general, we find a few ways that can create savings for our clients is to spread payments out over several years. This is like our car example, or even a 5-year mortgage. This can help reduce hitting those tax cliffs and filling up those higher tax brackets for large expenses. Taking advantage of lower income years means recognizing when you're not spending as much as you might in future years. And this is filling up those lower tax brackets, maybe the 12% bracket, if you know you're going to be in the 22% bracket in the following year because of a big purchase. And using different types of accounts can help here too. If you have other accounts other than just a traditional IRA like we've been using in these examples, say a taxable brokerage account or a Roth IRA, these can help supplement withdrawals to create much less of a tax burden. And I didn't get into covering this in as much detail today, just since I kind of knew we were getting close to our 20 minutes of content that we like. We'll have a future webinar on this topic as well, but I think we've talked a lot about how, Roth IRAs, for example, can be used to, supplement income in some of these years to reduce your taxes overall. And then lastly, don't completely write off loans for large purchases. You should never buy something just because you can afford the loan payments, of course, but if it's done correctly and at the low interest rates and an expense that's possible with your plan, it can be very beneficial. And so thanks again for joining us today. That's all I had prepared. Please feel free to ask questions now or later. And thank you again. Have a good rest of your week and a weekend.